Welcome to This Explainer. Today, we're going to master the modern equipment financing ecosystem together. Whether you're selling heavy construction machinery or, say, high-end dental chairs, financing isn't just some boring back-end paper-pushing process. It's actually a massive driver of sales and a really critical area of legal protection. We're looking at a complete end-to-end blueprint today, drawing straight from industry-leading sources to show you exactly how to utilize, automate, and protect your equipment deals. Let's get right into it.
Okay, let's dive into this. Here is our roadmap for today. We're covering 1. The vendor financing advantage. 2. Qualifying for equipment finance. 3. Automating the credit decision. 4. Navigating the dealer agreement. 5. Managing waivers and exceptions. And finally, 6. Asset protection and liens.
Section 1. The vendor financing advantage.
So, picture this. You're in a negotiation, and you ask, how do you plan to pay for your equipment? It seems so simple, right? Almost like an afterthought. But listen, if you wait until the very end of a deal to drop this question, you've honestly already lost control of the sale. Suddenly, you're putting all the pressure on your customer to figure out the cash, and worse, you're giving them the perfect excuse to walk away and shop around at their local bank.
Timing is quite literally everything here. As DLL points out, if you wait until the end of the deal to offer financing, you might have already discounted the price just to keep them on the hook. By pitching a flexible monthly payment right out of the gate instead of a massive, scary lump sum, you preserve your margins. The buyer focuses entirely on what they can afford month to month. That instantly increases their buying power and keeps them locked safely inside your in-house ecosystem.
Section 2. Qualifying for equipment finance.
Okay, so your customer enthusiastically says yes to a monthly payment. Fantastic. But to actually get that deal approved, they've got to prove they can handle the cash flow. We're talking baseline requirements here. A government-issued ID, 3 to 6 months of business bank statements to prove steady cash, proof of business revenue, and a clear equipment quote or invoice. At the end of the day, lenders just want a simple story. They want to know the equipment is real, the price is fair, and the borrower can actually afford the monthly hit.
So how does this play out in the real world? Imagine a landscaper applying for a loan on a shiny new skid steer. Step 1, they submit a clean application. Step 2, the lender verifies their identity and checks those bank statements for steady revenue. Step 3, they review your dealer equipment quote to make sure it matches the asset's market value. Step 4 brings that sweet conditional approval. And finally, Step 5 is the final funding, where insurance is confirmed and you, the dealer, get paid. A clean, complete document package moves through these steps unbelievably fast.
Now, what's really interesting about this is the stark contrast between financing new versus used equipment. New equipment? That's a total breeze for lenders. Clean invoice, clear warranty specs, boom, done. Used equipment, though, that is a totally different beast. It demands a mountain of paperwork. Lenders are going to want photos, detailed inspection reports, lien searches, and super strict proof of ownership. The lender needs absolute 100% confidence in the value and legal status of that used asset before they release a single dime.
Which brings us to Section 3, Automating the credit decision. So we just talked about a ton of borrower documents, but who or honestly what is processing all of them? $24.6 billion. Yeah, you heard that right. That is the projected market size for specialized credit decisioning software by 2033. To put that into perspective, it perfectly captures this massive industry-wide shift away from slow, manual underwriting. Today's lenders are relying heavily on advanced algorithms, machine learning, and API integrations to process all that data basically instantly.
And different players in the lending ecosystem leverage this automation in entirely different ways. Traditional banks, they prioritize strong compliance, deep audit trails, and enterprise-grade security. Fintechs, on the other hand, are all about that API-first architecture for rapid decisioning. They're using AI to ingest alternative bank data and approve your customer's deal in minutes rather than days. Knowing this helps you understand exactly how your specific lending partners operate, which means you can get your sales funded way faster.
Section 4, Navigating the dealer agreement.
So the crucial point here is shifting focus to your obligations. We need to talk about a major financial incentive that's also a potential risk: the dealer participation fee. Basically, this is a percentage of the financed amount paid back to you as the dealer. Awesome, right? But here is the massive caveat: the 180-day recapture clause. If your customer prepays their contract in full, or if they default within the first 180 days, you have to refund that entire fee back to the bank. It's an incredible revenue stream. Well, actually, scratch that. It's a great incentive, but it carries a real financial sting if the deal goes south quickly.
And honestly, the obligations definitely do not stop there. As a dealer, you have to supervise correct document execution, verify physical damage insurance before that equipment ever leaves your lot, secure first priority liens, and ultimately indemnify the bank for any of your errors. I know it sounds like a paranoid lawyer's wish list, but meticulous preparation at this stage prevents incredibly costly claims down the road.
Moving right along to Section 5, managing waivers and exceptions.
Because standard agreements sometimes hit real-world roadblocks, you've got to know how to maneuver. Let's compare two common friction points. First up, landlord waivers. If your finance equipment is sitting on a customer's rented property, the landlord might actually demand the lender assume the customer's rent obligations just to access the collateral if that's a default. Yikes. You have to carefully weigh if that risk is worth the deal. On the flip side, we have deemed acceptance. If a customer won't or can't sign a physical delivery and acceptance certificate, you can sometimes negotiate this deemed acceptance clause. That means if they don't complain within a set number of days, the equipment is legally considered accepted. It's all about finding alternative, smart paths to close the deal.
And finally, Section 6, Asset Protection and Liens.
We are now at the final stage of the equipment life cycle, and this brilliantly illustrates the absolute bedrock of asset protection, the UCC-1 financing statement. This is a legal form a creditor files to give public notice of an interest in a debtor's property. Under the Uniform Commercial Code, this is an absolute necessity. It allows everyone in the ecosystem to track encumbered equipment. Seriously, without checking these filings, you are flying completely blind on the legal status of any asset you touch.
Let's look at exactly how ignoring this can destroy your business. Here's a real-world nightmare scenario. Step 1. A farmer trades in an old combine for credit toward a new one. Step 2. Your dealership skips the UCC lien search, just assuming the old combine is owned free and clear. Step 3. Fast forward a few months, and the original lender shows up with a tow truck and literally repossesses that combine right off your lot. You just lost the entire value of that trade-in. No way around it. A simple database check prevents this total disaster and protects your hard-earned profit margin.
We have covered a lot of vital ground today. Equipment financing isn't just about moving inventory. It's about legally and technologically securing the future of your business. From that very first pitch of a monthly payment, all the way to checking that final UCC lien, every single step either makes you money or puts you at risk. The blueprint is right in front of you now. So, my question to you is, are you going to keep leaving money and security on the table, or are you ready to take complete control of your next big sale? Thanks so much for joining me for this explainer, and I will see you next time.